how to draw supply and demand zones is a lot simpler than many of you all may think, and I'm going to show you how to specifically be able to see a chart like this, draw very simplistic zones on your chart, and be able to make as much money as you possibly want just from trading these two little zones essentially on your chart. So, first things first, let's talk about what exactly are zones in the first place. Supply and demand zones are where the buyers and sellers specifically agree that a price point is extremely important. And I'm going to show you what that basically means. But as an example, the meaning is that if, let's just say, 202.30 is determined as important, then if the price goes up to, let's say, 203, which is higher in value than 202, of course, right? Then once things come back down to 202.30, it has a higher probability of bouncing up off that zone because 202.30 on the chart is signified to say, hey, this is specifically a zone. So conceptually, once things come down to tap it again, it's going to bounce, and that's where you can make and print as much money as you basically want to. So these charts that I'm going to show you specifically are created on the 5-minute chart, and they have 4 specific rules that you have to follow so you can actually be able to draw the correct supply and demand zones. So number one first is the following. So a demand zone as a whole is just very simple. A demand zone is essentially all it is the low agreement of the day where two candles agree. So there's typically two color candles on every chart, which is a green and a red. Green means the market's going up. Red means the market's going down. And we're going to look at the 5-minute chart very soon that you looked at as we go back really quickly over here. So green means the price is going up. Red means the price is going down. Each candle here represents every 5 minutes essentially. So if we go back to here, and this piece here, the demand zone, which I'm going to show you in a second, is the low agreement of the day where two candles are next to each other, where it be a green and a red specifically. Next is a supply zone. So a supply zone is the same thing but the opposite, right? So it's the high agreement of the day where two candles agree. And I'll show you again what that looks like in just a second. But you can see from before we even get into just charts specifically, it's technically the demand zone is the low point of the day on the 5-minute chart, and the supply zone is the high point of the day on the 5-minute chart. There's nuances to it, which I'll walk you through, of course, but just keeping it very basic from these 4 zone rules as a whole, just keep it like that. Next thing, zone movement as a whole. So the zones change throughout the day. So basically what that means is that just because, as an example, the highest point of the day was, let's just say, that 202.30, that doesn't mean that's always going to be the highest high of the day. It could potentially go higher than that, right? Maybe the new high of the day for the zone may be 204.20. And then that will be the new high of the day, which is technically called the supply zone. So zones can specifically move. So we have a demand zone, which is capturing the low point of the day, the supply zone, which captures the high point of the day. Then we have the zones, the fact that those two zones that we just talked about, they can move because, of course, prices just stay still. Stocks go up and stocks go down. So the high and the low of the day and multiple days can change. So the final and fourth rule is zone size, specifically on the 5-minute chart that I'm going to show you in just a second. The zones are typically 10 cents in size on average. And I'll show you now the next chart. So chart-wise, this is what I specifically trade, which is SPY, which is the S&P 500, which is the top 500 companies in the United States specifically. This is the 5-minute chart, and as mentioned, every candle here represents every 5 minutes when the market's going up and then when the market's going down. So every green candle, so this candle over here, is when the market went up, then it kind of went down afterwards, being red, then it went green, then green, to continue going up in an upward trend for the first hour, essentially. Then it went sideways. So a lot of people may, especially when you're new to trading, look at this chart and say, well, 1, I don't know what the zones are, but 2, I'm pretty sure I can only make money when the market's going up. And if it's just going sideways, there's no money to be made. I'll tell you for one, that's definitely not true. You can make money with the market going quote unquote sideways because when you think about it, this to here, as an example anyway, is the market going up. And you could also make money when the market goes down. So as an example, from here down to here, if you're correct about the direction, you make money. So that's all it is. But as far as the zones go, First things first, in order to draw zones for SPY specifically, the S&P 500, you have to wait until 1 hour after the market is open. So the market opens up over here in Houston, Texas at 8:30 a.m. CST. 1 hour after the market opens is 9:30 a.m. CST, which is what this blue line indicates specifically right here that I drew on this chart. For this specific one day being 10/11/2024 FY, if you do want to go look at it yourself. So next thing is that we can start identifying the zone. So keep in mind, the demand zone is identified as the lowest point of the day where two candles agree. So it has to be a green candle and a red candle next to each other. So with that being said, the lowest point specifically is this guy and this guy. So we go ahead and draw this little line and a rectangle capturing it. And if we go back, you'll notice that, well, before we go back, you see it's 576.63. That's the bottom of where these two candles specifically agree. So this line is sitting specifically on top of, on bottom of this little green candle because it's relatively close to the red candle. And the size of the zone is exactly 10 cents. So it goes from 576.63 to 576.73. And that's the size of the zone. It's very average size for most typical zones on average. And now you may be asking, okay, but what about this low specifically?
If you're looking to become a consistently profitable day trader that makes $10,000 per month, then go ahead and visit mkuniversity.com/info to get started. We provide one-on-one coaching for 2 months, and that way we actually hold your hand and walk you to becoming successful with our specific day trading strategy, which is trading one strategy with one ticker and day trading once per day so you can be successful long term and actually take care of your family. And it doesn't matter where you are, by the way. If you're new to trading or you're an experienced trader already, but you're still just not consistently profitable as a whole, we'll teach you everything from A to Z from the ground up so you can be consistent, so you can be profitable, and more important, you can do the things you want to do, when you want to do them, how you want to do them, and not have to be trading so much. Because the goal when it comes to trading is to get your life back and to get your finances in order so you can do everything you want to do. And by the way, we already have 1,003 video testimonials from people that are already successful using this strategy that you've been learning in this video. So if you want to be the next person, you want to be number 1,004, then go ahead and click the link in the description where it says apply for coaching, and you can go ahead and get started. And now back to the video.
This does not count as the demand zone as a whole because this is not the lowest point of the day. This is the lowest point of the day where the two candles agree because that's the most important piece here. This is the sellers and the buyers are both agreeing, hey, this is the lowest point of the day, right? This giant green candle is just a buyer. You need both buyers and sellers to agree. So this doesn't count as the low. This is the low for the demand zone as a whole. Next, things start getting interesting. So being that we looked at 9:30 a.m. CST, we do the same thing basically. We say, okay, well, a couple things. A, where exactly is the high of the day? For one, the high of the day it looks like where two candles agree, is 579.46. So we go ahead and draw that over from here all the way over, just basically that. We can pretend like all the rest of this on the right does not exist at the moment, right? We're just drawing this over. That's part one. Part two, if you notice, the size of this zone is actually smaller than this. The reason because this is the buyer, this is the seller, but the zone cannot be larger than the smallest candle. So rather than this being 10 cents, this can only go the max size, being as this little red candle here, which in this scenario is about 7 cents in size. So it's pretty close to this, but it's just not the full thing. So we draw that all the way over. And then, of course, that's our supply zone, being the high of the day where two candles agree. But, of course, the question is, but what about this high up here? Hindsight or not, we see that clearly there's a zone that's forming over here. But even without hindsight, we see that there was a zone, but it just broke above it. Technically, you're supposed to have things to come back down, tap this, and it bounces up to make some money on the upside. Or if it's a put, it goes down, hit this, and it falls down. You can make money with it going down to the downside for which is called a put, or shorting the market. So this high is interesting because when you actually go further, then you start saying, okay, once the next couple of minutes happen, this is 9:30, this is our major supply zone, then what is it? This 5-minute candle being the green one forms, and this red one forms, and this next red one forms, it starts going downward. Since it starts showing downward movement, and then we had a new high of the day, right? At this specific spot over here where the two candles agree, being the buyers and the seller, then we can delete this specific one and then redraw it. So that way, this is the new high of the day, where two candles specifically agree. And you can see what's interesting about that is that if we go to, if we go to the next side over here, this is where it taps and it falls down. So this is one of the plays that you can actually take. This is on the 5-minute chart, but this is one of the plays you can specifically take, which is an option put, because you can predictably make money when things go to the downside. The only thing is that this 5-minute chart is where you draw the zones. Where you do the entries, your exits, so on and so forth, would be on the 1-minute chart. And the nice thing about specifically this trade is your entry is somewhere up here. I'm not going to get into that. That'll be for the next video. Somewhere up here, and you can make all the money with it going down here. And FY, if you trade with what I trade with, as an example, this is specifically if I trade with say $10,000, which is about 100 contracts, give or take, then I can make $2,000 to $3,000 on just this move alone. Because you don't really need that much from a visual perspective. You don't need to take thousands of trades. You don't need to take a whole bunch of trades. You just need it to go up, tap the zone, come back down, and you let the trades come to you as a whole. And you can see after that, it finally went up, broke above this supply zone. Then it started going sideways. I don't have the rest of this chart here, but you can see technically by then you would delete this area. You'd redraw it up here for this being the major supply zone. And you can see technically it's very tight, but hits it, starts falling down essentially. So the zones continue to work no matter which, we'll go back over here. No matter how you use them, as long as you use them with these 4 zone rules, being A, you have to make sure the demand zone is always the current low agreement of the day. B, the supply zone specifically needs to be the current high agreement of the day. And before I go over to that, to C and D, of course, these have to be current. If they're not current, then as we saw with this, if this was stayed as the major supply zone and it came around, you would have lost a bunch of trades because you're get chopped up around in the middle of here. So it always has to be that high part of the day. Now, I'm going to do a part 2 and part 3 and so on and so forth on how to specifically do the uptrending days or all downward trending days, because of course, not every day goes sideways, but I'll leave you with this. Let's just say you, on a weekly basis, the market goes sideways 2 days out of 5. Just as a hypothetical, if you could also make $2,000 to $3,000 on each of those days, so we'll just say you made, on a worst case scenario, the $2,000 with it going from boom to boom, and that's twice a week, that's $4,000. Are you really upset that you didn't trade the other 3 days? That's fine. So even if you stopped just here, I haven't gotten to the entry and exit criteria, I haven't gotten to the take profit criteria, I haven't gotten into the stop loss criteria of where it's specifically supposed to do that. If you just did this alone, you'd make a bunch of money because it's systematic and proven with, as an example, the 1,004 plus testimonials that we've had from one-on-one coaching that the system works. And all these hundreds of videos that I've posted about proof that the system works. So if you want to know does this strategy really work, before you even get into the details, try it out yourself.